In the world of investment and trading, NASDAQ has emerged head and shoulders above all the other exchanges, especially for retail traders looking for high growth opportunities. The potential of disrupting technologies that may redefine entire sectors of the economy, along with the possibility for exponential growth in share price, has made many titles to begin their adventures here in the NASDAQ in order to become the titans of tomorrow, such as Apple, Amazon, Tesla, or Alphabet. With all those great precedences, it's normal for traders to also want to navigate those exciting and yet volatile waters of NASDAQ in order to identify a precise way to capitalize on the defining enterprises of tomorrow. I mean, after all, this is one of the birthplaces of the modern economy based on the connectivity, speed, and analysis using the tools and technology of a new era. Amongst all those titles that may bring us wealth and prosperity, there is Palantir, the data analytics firm based in Denver, Colorado. Palantir has been an enigmatic presence ever since it went public on the NASDAQ, with a reputation that has been shrouded in controversies. As a data aggregator and analytics platform, it has one of the deepest relationships with the public sector entities for large contracts in healthcare, defense, and intelligence gathering. Its price action is directly linked to the company's own fundamentals and risk appetite of the market, and with an increasing institutional participation in the company, there might be a lot more potentials to where the share price might go to. Before today's video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Over the recent days, Palantir maintained a stable position around $17.70, reflecting a slight decrease of approximately 3% over the last 5 days and a more substantial 15% decline over the past month. Though these short-term fluctuations may not carry overwhelming significance in the broader context, various factors beyond the fundamental considerations contribute to these market movements. The year-end period typically witnesses a relatively subdued atmosphere in the stock market, marked by fewer traders and diminished news circulation. Despite these conditions, Palantir has sustained an overall bullish trend, delivering commendable performance throughout the year. The prevailing consensus on the street is that Palantir is a commendable company, with noteworthy concern revolving around Palantir's significant reliance on the public sector, creating a somewhat top-heavy and less diversified client base. Nevertheless, this aspect of Palantir's business model has been well known since its inception and is likely factored into the current pricing. Looking ahead to the approaching year, potential fundamental challenges may emerge from the main street. As Palantir's clients primarily hail from the real economy, possible budget cuts for research and analysis at the individual level could present hurdles. However, Palantir has showcased its ability to not only generate profits and to maintain self-sufficiency in cash flow, but also to navigate evolving trends like artificial intelligence and large language models. While the fundamental profitability of these ventures remain uncertain, Palantir has undeniably garnered momentum in the market. As we traverse the dynamic landscape of the coming year, it is also very important to monitor how Palantir will continue to adapt and capitalize on those emerging trends, or the emerging trends to come, of course. That being said, here are the technicals. The trading volume of Palantir has been around 40 million shares, compared to the average volume of 56 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $21.85. The volume of shares traded tells us how many shares have been bought and sold at any given point in time, and if there is enough liquidity to support a trading strategy. If the float is thin, it would be easy to influence on the stock price, but the low liquidity could also mean that the demand might be limited. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume can be significantly higher than the average volume. The market cap of Palantir is currently at $38 billion, compared to the enterprise value of $15 billion. When we compare the current price to the historical price fluctuations, the stock is 1% higher than the 1-month low, 19% higher than the 3-month low, and 194% higher than the 52-week low. On the options market, which gives us a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 50%, compared to a historical volatility of 49%. The put-call volume ratio is currently around 41%. It is normal for many stocks to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 222,000 contracts a day versus the 30-day average of 293,000. In terms of open interest, the most recent volume of open interest is around 3.1 million contracts versus the 30-day average of 3.1 million contracts. Regarding the shareholder structure, institutional shareholders own 40% of the total float, which is likely as a result of the short selling of the outstanding shares. The biggest shareholders include Vanguard, Renaissance, and BlackRock. Usually, it's best to see some institutional participation when holding a stock long-term, because it offers a layer of stability and token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, which is an important factor to consider for the investors. I believe that the minimum threshold should be around 30% for institutional ownership to consider long-term investment. The current short interest is around 6% of the total float, 53% of which come from the dark pools. So usually we would consider the argument of a short squeeze or the presence of a concerted institutionalized short attack on a stock if the short interest is above 15% of the total volume. It's not the case at the moment, and frankly, if there's any sort of shorting going on, it might be on an individual basis, because after all, Palantir is one of those stocks that gather positive and negative sentiments, so it shouldn't be too. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like NASDAQ, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one, the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Overall, I hold the view that Palantir will maintain its relevance in the years ahead, notwithstanding the current erratic volatilities the stock is experiencing due to arbitrary circumstances. Therefore, it seems reasonable to gradually build a position over time, disregarding the short-term price fluctuations. The strategy implies an assumption that the portfolio aligns with the appropriate risk appetite for technology stocks. I would recommend to commit between 3 to 5% of your portfolio in Palantir overall and to split the allocation in batches of 20% over a period of multiple months.